Hi, I'm Robert Greaves, and this is The Point. Today on The Point, I'm with Trinh Nguyen, Senior Economist at Natixis, based in Hong Kong. We're going to talk about macroeconomic trends, Asia economic trends, and we're going to talk about finance and other issues. Trinh is also a rising star on Twitter, where she talks about finance, history, and economics. Trinh, thank you very much for joining us today.
Thanks for having me.
I wanted to ask you, let's start out, what are the trends in Asia right now? What's going on?
Well, Asian economic engine is slowing down quite significantly. And although we're having a very hot summer in Asia, the temperature for economic activities has chilled quite significantly. And at the center of that is really the deceleration of China as a growth driver for the region and the world. China, since the great financial crisis, had been a key driver thanks to its fiscal stimulus, monetary stimulus, and that stimulus up to this point has increased the leverage ratio to a point that it's no longer sustainable to do so. And as a result, despite the monetary easing and the fiscal easing, the risk appetite in China has been reduced quite significantly. We see that the lending data shows a significant reduction of lending. What that means is the private sector in China is reducing its risk appetite. On the other hand, we have an increase of government spending to support that, to put a floor to growth. What does that mean? Putting together everything, we're seeing domestic demand decelerating in China, and that's bad news for the rest of the Asian countries, particularly those that depend on Chinese demand to grow. For example, we have South Korean exports declining by double digits. And at the center of that is the double digits decline of Chinese demand. We have Singaporean exports declining as well. And across the region, many countries are suffering from this weakness of Chinese demand. And we can see that the year-to-date import figure in US dollar by China contracted. That is important because it's not just regional demand that's decelerating. We have demand in Europe, such as Germany, where you saw that it went into contraction in the second quarter, and that is very much related to the weakness of auto in China.
So if you take that with a decelerating or slowing economy in the US, are we going into a global recession?
Well, the market is fearing this and pricing this quite aggressively yesterday, right? So what people saw yesterday was that the 2-year and the 10-year inverted. So in no layman terms, what that means is that people are expecting the economy in the US to slow materially, causing the Federal Reserve to cut interest rates. So therefore, the inversion of the yield curve. Now, on the short end, obviously because the Fed hasn't cut materially yet, they're waiting and hoping. And the reason why markets, both on the financial market side and in the Asian market side, hoping and expecting the Fed to cut is that the dollar is still a huge lubricant of the global economy. What does that mean? That means that trade invoicing, for example, in China, 86% of total trade is invoiced in US dollar. And across the world, the figure is the same, meaning if the dollar continues to be strong where it is today, and it has strengthened quite significantly versus the euro, versus the yuan, versus the Aussie dollar, versus across the board. And if it continues to be this strong, what that means is that we're going to have the tightening of the dollar, tightening financial conditions, and via not just rates, but also via real activities just as trade financing. And that's a key bottleneck. So everyone is really hoping that interest rates in the US will fall, but not materially, as I'm against negative interest rates, as you're well aware, but will fall so that it really allows for their central banks to respond to their own domestic conditions. A good example I want to show you is that in 2018, we're already there. The Asian region was slowing in 2018. But we couldn't really do anything about it because the Fed was being very hawkish because the US economy was so strong. So when you have this huge divergence in emerging Asian growth versus US growth, what happens is money flew back to the US and causes instability in Asia. And as a result, many Asian central banks, in contrast to what their economic cycle asked them to do, hike interest rates, right? So the key difference between 2018 and 2019, we still have trade war, we still have China slowdown, we still have everything that's happening, but we hope that at the very least the Fed will cut interest rates, and then therefore we can really help ease the deceleration and put a floor to growth, and hopefully we can find a bottom to Asian slowdown soon.
Okay, so from the vantage point of Hong Kong, which is facing a little unrest currently and also the effects of the trade war, is there anything good? Are there any bright spots in Asia we can point to?
Clearly, it's very difficult to really escape the downward velocity of global slowdown. But in the midst of this, trade war tension, there are some arbitrage opportunities. So clearly, the structural trend of Asia is that we're aging. So from Japan, which led the race to aging since the 90s, we have Korea, we have Singapore, we have many countries, including China, that are going to age. What that means is that it's going to push upward pressure on wage costs. So countries that are prepared to take advantage of this, on top of the escalated tensions between the US and China, that also prepared to take advantage of the arbitrage between the tariffs between the two, will benefit. A good example is that you're seeing Vietnam doing rather well because it has positioned itself as a China +1 arbitrage location for the region, and as a result, you see foreign direct investment has been rising for a long time, and at the center of this was really the aggressive policy by the government to really liberalize Vietnam and positioning itself, right? It is not the only country that can arbitrage this. India is a good example where, to be fair, only country that's comparable to China in terms of geography and population size. Now, India hasn't been as aggressive in positioning itself, so it needs to take those steps to really take advantage of it, but it is in a very good position to do so. So let's hope that it will not just talk about positioning itself, but would actually take actions to really make it a friendly environment for foreign direct investors.
So you talked about negative interest rates and zero interest rates. Why, in your opinion, I think you've tweeted about this, why are they so bad? And what does that lead to, in your opinion?
I would compare it as, let's just give an example of the two countries that have, not two countries, two basically region. One is the Eurozone, and then we have some Nordic countries as well, the Eurozone, and then we have Japan that went into negative rates. The key point of central banks that try to do this is really the process of deleveraging. The whole purpose is that lower your interest expense so that the cost of interest expense is so low and the nominal GDP growth is higher, right? So by a fraction or mathematically, you then delever, which is essentially what happened to the Eurozone. Now, but that has a cost, right? The cost of this is that you compress margins for your key, what we call a key agent to transmit to the rest of the economy. In the Eurozone, very similar to China, is very dependent on banks to really lend to the corporates. And what this does is compress the margins of banks. And as a result, European banks, if you look, have been suffering quite substantially, and so are the Japanese banks. But not just because of that, it also pushes banks to take risks, right? So when you have the ECB took rates to negative from negative 0.1 in terms of deposit rate to negative 0.4, and markets are pricing for further negative interest rates. And what that means is that it's pushing banks to take risks that it wouldn't ordinary risk take. For example, pushing banks to lend to real estate, and so it's pushing asset prices upwards. So if you look at countries that take negative interest rates, asset prices rose significantly, and so therefore it creates a widening gap of those that can access capital and those cannot. And this is a huge issue of our time, is that this rising of inequality is going to create, and actually has already created, the rise of populism in the West. And we continue on this path to use a medicine which side effects is much more massive than what it's trying to fix. And in reality, what is really needing fixing really requires structural reform, which is fiscal policy that policymakers haven't really been able to address. A key example is the slowdown and the deceleration of Japan has a lot to do with its demographic issue. which we have known for 2 decades now and haven't really done anything about it. And as a result of that, you have a contraction, not just a deceleration of population growth, a contraction of the population in Japan. When you have a contraction of the population, what that means is your domestic demand declines, and also your comparative advantage in terms of wage costs decline. So all those reasons pushes growth downward in Japan. And in fact, if you look at its low growth relative to its population, it's actually doing a quite good job in making sure that growth is, above zero is actually relative for the decline of population is quite decent. Now, this is going to happen in Europe, right? Europe's going to have a depopulation issue, and that's going to push downward pressure, but that's not the only issue Europe has. It has an integration issue to cohort. I'm not a European economist, but the whole point is that many of these issues haven't been addressed, and they need to be addressed. Central bank's jobs is really to smooth out the business cycle, not to completely erase the business cycle. So what happens when we postpone business cycles is that we're going to have the pressure cooker is going to build. So at some point, we're going to get to the point where, such as what happened yesterday, is that the German economy went into contraction, right? But the entire yield curve has been negative. So what is going to happen next? So what can the central bank do? Basically, we're entering winter when we have burned all the woods.
Okay. Well, that's interesting. Now, there's a quote here that I want to play back to you or repeat to you. You said that emerging markets sell-off beginning last summer was like a bad game of ping pong hit between Argentina and Turkey. Can you explain why you said that, and what does that mean, and is it still relevant to us?
I think the emerging market sell-off in 2018, as I explained, is really about the dollar, right? So many of these countries, if you look at, they have benefited quite substantially from the cheap capital inflows, and we just discussed that capital became very cheap, and when you have cheap capital, what you do, you need to hunt for yield, right? You need a certain return, and in this hunt for yield, you ignore risk. You just go buy riskier assets. Now, it's up to the host countries to manage that capital inflow, to manage what you do with the huge influx. And a lot of these countries do not manage these imbalances very well. A good example is you look at Turkey. It had a huge current account deficit, right? Didn't manage very well, and it became very dependent on foreign investors, particularly the dollar. Now, when the situation changed from a very zero interest rate environment to a positive interest rate in the US, where interest rates went to 2.5%, growth differentials between the US and the emerging markets narrowed quite materially because US growth was doing really well in 2018. What happened? These countries did not cope with this very well. So that's very much a dollar story and more the sustainability and the rebalancing that needed to happen. And that's what they did. They raised interest rate. Turkey did the same. You have a huge contraction of imports, and then it's rebalancing in a difficult way, right? So you can do it an easy way or you can do it the hard way, and they took it the hard way. Now, the positive side of this is that the Fed is no longer hawkish. It actually cut interest rates, and markets are hoping it would do more. Now, from the Argentina side, the current sell-off has a lot to do with idiosyncratic risk about the fear of the political transition. So there you have a macro theme that's playing a part of this, but also there's idiosyncratic risk in these countries as well. So since 2018, looking in 2019, a lot of the moves in Turkey and Argentina have a lot to do with how they manage their own political system and economy in general. For emerging markets in emerging Asia, I think there's a lot of fear prevalent, but one benefactors of this really is the bonds, right? Like, for example, current account deficit countries such as Indonesia, the Philippines, and India, for example, instead of being fearful of the Fed, they have actually taken steps to lower interest rates, right? So which means that they're able to ease financial conditions and helping their economy with this gentle deceleration. Hopefully, we'll all get a soft landing in Asia.
Okay, great. So the name of this series is The Point, this show. So every episode, we try to give viewers the point. What is the one point? What is the one thing we should take about Asian economic growth or development over the next 6 months to a year?
I think the theme from now and actually, in fact, in the next decade will be as China transition to from an investment-led to more domestic consumption-led, also from being a huge growth driver of the world to really managing, stabilizing its own economy, etc., etc. How is the rest of the world going to cope with a situation where a key growth driver in the past decade had been China, and moving forward is going to focus more on stabilizing its economy? Then how is the rest of the world is going to cope? And where is the next driver of growth will come from? Clearly, China is a massive economy on a continental size, so there are pockets of strength and weakness as always. But beyond this, on a macro story, countries such as Singapore, Korea, and many other external dependent countries such as Germany will have to look at for sources of growth. And just not just beyond China, we're actually looking at also in the transitional trends of changing of technology, the increasingly more automation, the roboticization that has massive impact. So there are massive changes both at a macroeconomic level, a geopolitical level, and those are most nimble will position themselves and will do much better than those that look into the past rather than the future.
Thank you, Trinh Nguyen, very much for this discussion. And that's the point for this week. Follow us on Facebook, LinkedIn, and Twitter, and let's continue the dialogue.